Hi, thanks for coming. I'm Chris Hempstead with Mirae Asset Securities. Welcome to OnTheVine, our video and audio podcast series. One thing I want to do today, just a little bit of housekeeping, is bring to you a little bit of, maybe some knowledge or information about why we're here and what we're doing. So Mirae Asset Global Investments, and Mirae Asset Securities collectively have a broad expanse of businesses across the globe. It's real estate, it's securities, it's wealth, it's asset management. The firm is heavily integrated in the ETF ecosystem. So what are we doing here at Mirae Asset Securities USA here in New York City? We've built out and complemented to our existing prime brokerage, securities lending, agency execution, and repo desks. We've complemented that business line with an ETF desk. We are an authorized participant in over 90 ETF trusts covering the majority of US listed ETFs. We are a global portfolio trading desk. We have seed capital that we can deploy to our partners and clients, and we are engaging in lead market making activities. And so we're trying to basically fill all of the roles and needs of a good actor in the ETF ecosystem here in the US and of course globally. One of the things that we constantly get asked for is help in distribution, and that is very hard. It's a hard thing to solve for. Distribution is probably the piece of the puzzle that most asset managers have the most need for help with. And while we're not a distribution firm, we do talk to clients regularly, and we get inbound requests globally and domestically from hedge funds, pensions funds, other broker-dealers, RIAs, looking for advice on ETF selection, ETF product availability. What does a particular ETF do? Oftentimes, how do we launch our ETFs? That is a service that we provide. We love doing it. We have the knowledge, we have the expertise, and so we want to share it to foster new relationships, and it fits perfectly within the mandate of Mirae Asset Securities. With that, I'd like to introduce my next guest, Alexander Morris. Now, Alex was brought to us exactly for the reasons that I just mentioned. Someone was interested in learning more about the ETF structure here in the US, thinking about bringing a new product to market, a very unique product you're going to hear about. How can we help? What can we do? How can we get them comfortable with the process? And so we put the time in and we spoke with them, and then they made the decision ultimately to launch a suite of ETFs unlike any other that have been launched. You'll hear more about it in a second. And we've developed a relationship as a result. And I'd like to introduce Alex Morris and have him talk about his suite of single security treasury ETFs.
Thank you, Chris.
Alex,
Look at
thanks
that.
for making the trip up.
That's a great shirt.
Thanks.
Get me one of those.
Who picks a color like that on a day like today? I picked pink because it's very hot out in New York City today. We're in the midst of a heat wave, so I figured we would take the temperature down a bit. But Alex, I'm going back almost one calendar year to the date, I think, which is purely coincidental that you're here today. One calendar year ago, we started the process of seeding your first ETFs. Can you tell us how you got there and a little bit, well, I don't know, maybe the first thing is, what's so special about your ETFs and your expertise? How did you come to the conclusion that we should launch a single security treasury on the run ETF?
Yeah, it's been a year. It's been a year.
Happy anniversary.
Thank you. We started off with zero, and TBIL, which was the fund you first seeded for us, is almost 1.3 billion today.
There you go. So if you need someone to help seed an ETF, here we are, 1.3 billion.
It's the first bit that's the hard ones, right? So when you and I first started talking, we had this simple problem. Treasuries were about to become popular, or becoming popular again after a decade of choose your flavor of zero, and we wanted the material return we saw coming from them, the anti-correlation to U.S. securities, the U.S. broad equity markets. But it's hard to do, particularly when you run a pretty diversified book like we do at FM. We have clients who are institutional clients. That's pretty easy. We have ISDAs, we can use futures, we have options, we can buy cash bonds. But when you start to get to more investor advisory relationships or in retail clients, now all bets are off. Some of our clients, we discovered, if we weren't making 3.5% to 4% on a treasury, would actually cost the investor money to do the trade. After you think about all the hands that are in the till there of their broker-dealer, their sub-broker-dealer, their platform, ticket charges, put it all together. So we want to find a way to avoid that. And we thought, well, we'll just buy an ETF, Treasury ETFs. There's a lot of them. Turns out not all of them are going to do exactly what we thought. Most of them are based on indices that are pretty old, and they're based on indices that follow how the government does its accounting. No one really goes to the government for your investment strategy. It's good for government accounting, not really great for investment theory, particularly when you're used to seeing the yield curve. And we just wanted that point. We knew how to articulate a view around the various benchmark points. So we went out and said, well, someone had done this. Someone has made it very easy to buy the 10-year or the 2-year. And it turns out no one had. So then we had the wacky idea of, well, maybe we should do this. We should launch an ETF that does this one kooky thing. It holds on to the on-the-run benchmark of each of the major points in the US yield curve, because those are the things we think about. Everything from your mortgage to your car loan is based off of the 10-year. There's not a particularly good way to buy it in an ETF. There's not a particularly good way to buy it outside of the way we've been trading treasuries for the last 100 years. Maybe we made it faster, but it's no different. So we wanted to provide folks that exact point, stay on that point, and give you the ability to really articulate a rates view, regardless of the size of your account. And because of Mirae, we got to make that happen.
So it's the simplicity-wise, the liquidity, and we always talk about this in ETF circles. We talk about this in our education podcasts and things along those lines, seminars that we go to. Liquidity of an ETF is definitely nothing to do with the actual volume or the assets in the ETF. It has everything to do with the security that is used as the ingredient to make the ETF. So when Alex came to me and said, well, for TBIL, TBIL, that's the 3-month US Treasury bill, which I kiddingly say has infinite liquidity. I think a lot of people would say as long as the US, the Federal Reserve, I guess, is willing to print money.
Yeah. Once the Treasury is willing to do it and the Fed is willing to take it in its bank account. And,
right.
And spoiler alert, they will.
And they will. And it would be, I think, a big problem for everyone if they didn't. So in terms of liquidity, it's seemingly infinite because the ingredients that they're asking for to make new shares of the ETF are, in this case, the 3-month T-bill. And I'm sure that liquidity profile changes as you move out the curve. You came to market with 3 funds. You now have
all 10.
You now have all 10. So you've got the 3-month, the 6-month, the 1-year, the 2-year,
the 3, the 5, the 7, the 10, the 20, and the 30.
And then does the liquidity curve kind of look like that, or is there more liquidity on the 20 or or than on the 10, or like how does that work?
So I think
in fixed income world, and forgive me for asking, I'm mostly an equity trading person in ETFs. And their underlying equities, so my expertise in fixed income isn't as high. So I humbly ask.
That's a fair question. Like 80% of ETFs are equity ETFs, so it would make sense. And I think this is part of the reason why fixed income ETFs are that less than 20%. It's because bonds are weird. They've got odd math. You trade things in price, but you think in yield. It's got all this other stuff. The good news is the Treasury is pretty ecumenical in where it will give out the debt, and it really looks for where it can get the best deal for the American taxpayer, which is ultimately what it should be doing. The one item that has some sort of structural cheapness to it, so yields tend to be higher, is the 20-year. And that's just because the government stops offering it every now and again, primarily used by life insurers who have a 20-year risk to close window. But the 10-year, for example, could actually be the most liquid security on planet Earth, outside of maybe a $100 bill itself. There's substantial liquidity there, and it is why it's the benchmark for so many things. There have been plenty of folks who have bought their first and second summer homes trading the 3s and the 5s. So lots of liquidity, highly active, a lot of risk takers in that space, and a lot of folks writing risk, particularly in the REIT world, or folks who are doing short-term loans for construction or commercial real estate. And then the other ones tend to be highly liquid. Certainly not, there's no liquidity issue of could we ever in our ETF fill it up, or could even the Treasury ETF world start to fill it up? Plenty of access there. Every now and again, like the debt ceiling came up, and there it wasn't the question of, hey, would one be liquid or not the other? The question would be, is this country liquid and solvent or not? And we noticed that the short end of the curve spiked way more than anywhere else. And that was just a byproduct of folks are worried if you're not going to pay a debt, you're probably not too worried about the thing that you've got 30 years to pay. The thing that comes due in 6 days is really more of a pressing liability. But even then, rates on that bits of paper only went up to about 6.5%, 7%, which sounds terrible, and in the grand scheme of things for the US where we were, it was pretty bad. But if you compare it to global debt all over the world, it was a fairly modest number.
That kind of, you triggered a question in terms of the ability and the utility of your product suite for an advisor, for an individual, for an institution for that matter, which had me thinking a lot before you came in of a foreign institution has reached out recently saying, hey, we want to trade treasuries in the US, right? And this happens all the time. We get calls like this all the time. And what I'm trying to solve for is structurally, functionally, how does that work as a business? Can we support that request? Can we operate that for them? Is that the most efficient solution? Providing treasury execution services and things like that for this particular client at this particular time. And for the first time ever, I can go back and say, well, what is it you're looking to buy? Oh, we're looking to buy T-bills. We're looking to buy the 10-year. Have you considered an ETF? Is the structure of your treasury demand and such that you need to actually own treasuries, or can you own treasury exposure that's very measured and very precise to exactly where on the yield curve you want to be? Have you been fielding a lot of calls yourself from institutions that traditionally would be trading their own treasuries, but either by way of resources or by size and scalability, they've looked to the ETF and said, this is a no-brainer for us. The cost structure is right, and it's much easier for us to just buy 10, 50, or $100 million of an ETF than to go out and manage a treasuries book.
So we've had some of those calls early on. Folks said, let's see if this works, right? When you do something new, a lot of folks want to sit on the sidelines and make sure it actually gets off the launch pad and into space. And now that it's gotten there, folks have called and asked us to do that. So to the point where we've done some analysis that's kind of interesting, particularly for institutions. We looked at what would happen if you bought a 90-day T-bill and just held it to execution and held it to maturity versus buying T-bill itself, TBIL. And it turns out you get about 6 basis points extra for holding TBIL, net of fees. And it's just a byproduct of how we do the roll. And that roll process is really critical. Most folks, when you look at the yield curve, you forget that that's a constantly evolving set of bonds. The yield curve today will have a different set of CUSIPs on it in a week, in a month, in a year. And if you were to go and type in US government debt, it's about 2,000 CUSIPs, so individual securities at any given time, right? The 30-year is issued 4 times a year, same with the 20 and the 10. Everything between 1 and 10 is issued 12 times a year, and then all the other ones are issued every week, so 52 times a year. So you start to get all of this. So if you said, I want to buy, say, a 2-year T-bill, or a 2-year T-note, the question is, well, which one? Do you want 30-year that's 28 years old, a 10-year that's 8 years old, the newly minted 2-year? Because when you look at the yield curve, that's what you're actually getting. And you get this weird thing where, because you're looking at the yield, prices move around, you get tax implications, it's confusing. Prices get different, there's different liquidity profiles. Most folks who held onto a bond for 30 years, 28 years, are gonna hold on to it for the next 2. They had it for a reason, they're not looking to get out. So we solve all of those equations by saying, we want the on the run. The on the run is the most liquid series at any time. So even though there's a lot of, say, that 30-year in existence, the actual market for it is pretty thin. But that on the run is the one that you had to have an active buyer today. You went to the government, you gave them your money. And there's a very active community of folks that are on the run and 2, 3, 4 generations old. Go beyond that, and all of a sudden liquidity dries up. It's not that it's not there, there's just not a market for it. It's much harder. Those folks are tucking those bonds away in portfolios for some purpose, generally over the course of months and years. So we did that analysis. What if you just bought and held it? Well, because we do that roll and we're able to take advantage of those first few tenors of those bonds, we do a better job of maintaining a premium value, and we can actually deliver that net of fees back to investors. Or you could do this thing where you just wait for it to mature, and 4 times a year or 10 times a year or once a month, someone comes in and has the worst Tuesday of their life, as all they do is roll the treasury portfolio. You can't win. You can barely break even, and if you do a bad job, you get fired.
Well, this is, I have to ask, many managers and issuers who collect, fees on assets under management, and yours is very competitive, by the way, your fee structure at least. But the question I'm going to ask now is, for people that have situations that you just described, does anyone come to you and say, hey, can we borrow this security so we can short it? I want to take the other view. I don't want to be long the 2-year. I want to be short the 2-year. And one way to do that would be to work with a securities lending desk to borrow your security and lend it out, which the shares have to be created to do that. So it's good for the manager.
Right.
But an inverse product for each point on the yield curve, is that something that could be in the mix? I mean,
sure. So we certainly have folks come to us and say they're shorting it. We were so excited. We're like the only people who are so excited to see there was a active short in their product, because folks were doing exactly what we thought they'd do. Like take the 2-10-year spread. To do that, you have to long the 2-year and short the 10-year, or vice versa, to look at a flattener or a steepener. And we wanted to be able to give people that product. Now they could build it on their own. And that may be something that you'll see coming out from us in short order. May not be every point on the curve, but certainly some of the most popular items are ones that folks have asked us for some time. And the products are mature enough now we can do that. The same with there's a listed options market. It's not as liquid and as well matured at this point as perhaps we'd all like it to be, but we'd like it to be as big as some of the ones on these mature 20-year products. But hey, we're a year in the market, we're willing to be patient. But ultimately, you'll see those come out as we really want to take that rates tool set to everybody. Like, why should you have to be a multi-$100 million user to be able to do things that you know what you're doing and you want to be able to deliver? And then obviously we have to put the right risk controls on. Right. The goal of particularly the Treasury market isn't to allow folks to run away with leverage, but to provide exposure to rates going up and down, to expose people to spreads collapsing or expanding, which is pretty common set of trades. And then from there to allow them to really use those as the building components of a really meaningful portfolio. And the beauty of what I'd argue we did in T-bill, X-bill, O-bill, and these are some of the great tickers that I think we didn't believe we were going to get. And when I told you these, I think it was like
T-bill. I couldn't believe. T-bill. That was a shocker. When they got TBIL, I said, "Oh, that's."
How did they forget that one?
Yeah.
Or 2-year, which is U2, UTWO, UTRE, U5, U7, U10. How did someone miss that? UTWI and UTHY. But how do you take all of those together now, add some of the interesting spread plays, and allow folks to say, "Here's my credit portfolio. And I've got a couple of active managers who are doing this, and I've got these bonds that I have to hold on to for whatever reason. But I really don't like the look of the duration or the maturity, or I want to take advantage of short-term, coupons that I can't get by cycling out into higher corporate debt. I get higher yield if I hold on to it for the next 6 years, but I'm not getting a higher coupon. How can you use these single points on the curve now to change the dimensions of your portfolio without adding credit risk?" And that's really what the genesis of this was for us. We didn't want to keep using the other ETFs that had either an active view or had this sort of constantly changing duration, maturity, bandwidth that just happened based on how much debt had been issued in the past. We wanted to know we would stay exactly at this point. And this gives you that sort of more, rewarding ladder. As opposed to just buying a bunch of things, waiting for the top rung to become the bottom and recycle.
Right.
Every rung just stays in place exactly where it's supposed to.
Well, as you start to think about new strategies, the long short side of things, or a new product or things like that, you'll probably need a prime broker. So we'll love to be in those conversations. I'll introduce you to that team.
Sure. So FM Investments is a multi-boutique. We start off with the simple premise that there are great portfolio managers out there, and they really tend to be good at doing one thing: managing portfolios. But we often ask them to run businesses and to do all these other jobs that they're not particularly well suited to do, or if they are, just a distraction from focusing on markets and delivering value to clients and investors. So my business partner, Dave Littleton, and I started off the business simply to create all of the infrastructure that an investment manager needs so they can do that one job, and then put enough of them together where we can take advantage of scale. So any one of them, if they did their jobs well, would build more or less the same thing. Let's build it right. Let's build it once. Let's start putting interesting ideas and interesting portfolio management teams together. And the benchmark series really is what happens when you put enough of that fissile material, and the chain reaction starts. You've got someone who knew about ETFs, someone who knew about rates, someone who knew about what clients needed in their portfolios, came together, and a meeting of 3 people in an hour birthed the idea, and then had the ground game to put into play. And then we joined forces with Diffractive Managers Group, which gave us a sales team and ability to really take the product to the street in a way that those of us who spend all day behind the Bloomberg screens, probably not the best suited to go and talk to thousands of people about the product. So we teamed up with Diffractive, merged companies together, and now we've got a great company. And we're always looking for folks who have new ideas that we can help implement, and folks who are on teams who are looking for a place to go where they can hang a shingle with us and be part of a great team.
There's a short list of ETF managers in this country who have come to market and inside the first year raised well over $1 billion. Are you over 2 at this point, or all in?
If I look at intraday action, we're at $2 billion.
Yeah, it's pretty incredible. It's something you should be very proud of. Where can investors find more information on your funds and the fund structures?
For the funds, US Treasury ETFs.com has all the information about it. And
they got that too.
And or you can just search FM Investments, and we'll get you to the same place.
Great. So TBIL, we seeded TBIL about a year ago. It's got well over $1 billion in it today. TBIL is the 90-day on-the-run Treasury bill ETF. What we think of as probably one of the most liquid securities, the T-bill itself, on the planet. You're going to mention in a minute a different one, but
well, as you put it, I think it's where you say infinite liquidity. And you weren't the only market maker who used that sort of phrase. Part of the downside to seeding is you've got to get balance sheet and give it to us for an idea that is yet unproven. And there's a balance. Every issuer wants you to give us $1 billion. Makes us look great, great fees. And every market maker wants to limit their risk. And this is one of the few products where it was really important to tell a story early on. Don't look at how much assets are in day one. And frankly, as you educated me, it's the stuff inside that matters more than what the thing trades, because you will always give liquidity if you can take the things inside and find a market for them. These are highly liquid. We had another market maker who told us, why would I seed anything at all? I'll just offer you near infinite liquidity on the name because I have near infinite liquidity on the back end. And those are phrases that no doubt would make compliance very nervous if someone actually was putting that in the market. But we ultimately proved that out to be the case. Even our security, even the ones that came out, had super tight spreads from the get-go. And some ETFs will spend their whole lifespan and never get to a penny spread. And you brought T-bill, UTWO and UTEN to penny spreads within days of them being on the market.
Yeah, I mean, it was a collective effort among many market participants. But I will say that it was a fun one to be a part of, and for us here, you were one of our early partners in our build out of our ETF operations. So we really appreciate your trust.
Happy to do it.
We were really happy to put our best foot forward, and we'll just keep working towards solutions as they evolve.
And ETF participants that work together dress together.
That's right. So we're flexible. But thanks so much, Alex, for coming in. Really enjoyed chatting with you, and looking forward to the next year of asset raising and product development, and can't wait to see what you bring to us next.
Looking forward to it.
Great.
Thanks for having me.
What we like to do, at the end of these podcast series is sort of tell you what we're thinking about. And one thing we do is consume a lot of data. We have over 3,000 ETFs listed here in the United States, across our exchanges. And some ETFs, most ETFs really, by the percentages, don't really trade a whole lot. There aren't a lot of super exciting things happening. The stories are great, the investment philosophies are great, and the passion behind them is great, but they won't trade like an SPY or a QQQ on a daily basis, right? And so we look for heartbeats, if you will, or pulses in the market that tell us where people are gravitating to new ideas, new strategies. It's very hard for individuals without all of the data to find those things. And so I'm going to point your attention to a chart that we have here that shows some of the fastest growing ETFs in terms of AUM in 2023. And these funds are all funds that have seen tremendous growth, who started the year with less than $10 million in assets under management. It's important to take a look at some of these things, not because they're necessarily the right vehicle for you, but to give you some knowledge and comfort into knowing that as products come to market, new ideas come to market, they're very investable. We always have conversations with new managers who are struggling to tell the story of how their clients can efficiently buy or sell an ETF in the market when it's new to the market and it doesn't have a lot of volume. There is a process to that, there is a comfort level to that, and if it weren't for people learning how to do that and understanding how to do that, we'd still probably only have 2 or 3 ETFs listed in this country. It's because people learn about the funds on this chart and funds like it before them who have grown with people who are essentially pioneers and saying, I love this strategy, I know how to trade an ETF, I'm going to invest it, and I'm going to tell my friends at the country club or at the school dance or whatever it is about how I found this ETF and how I invested it and how I got, a product that fit what I wanted. So we challenge you to do it. We challenge you to ask questions, and take a look at some of these names. They're newer names. They might have less volume. They might have less AUM, but they're equally as exciting as any other ETF you can throw out there. Around the globe or around the country, I guess recently we've seen some pretty good activity in the home builder sector and the tech sector. I mean, ITB and XHB are two of the household home builder names. It might be interesting to keep an eye on those as we get into, August, September of 2023. And the tech sector, the benchmark for that would be XLK for now. There's a ton of other tech ETFs out there to look at. Some of them are very focused. Some of them are very diversified. You can probably find every flavor of tech that you ever want to think of. But if you want to get more information, please feel free to reach out to us. Chris Hempstead with Mirae Asset Securities. Love to chat more with you and look forward to our next episode.